We have our quantitative panel for right after lunch, so we're going to really wake you up because this is the best quantitative panel you're ever going to see. So I cover sustainable finance at Bloomberg, and this is an amazing panel because there's never been, I'm told, an ESG quant panel before. It's a relatively new space, and we're going to talk about ESG data. And I know all of you see ESG as one of the biggest buzzwords on Wall Street. There's about 30.7 trillion in assets globally tied to ESG in some form or another. It's been growing much faster than regular assets in the market. And we have a poll to start because a lot of this ESG information is based on data. A lot of these strategies are based on data. Is there the poll, Kylie? Just gonna wait for 1 second. Okay, so get your apps out. How much do you trust ESG data when it comes to investment decision making? How are we doing? Everybody have their apps out? I'd like to know more, but I'm still putting money to work. We'll just give it another minute. There we go. I don't trust the data. Coming up there. Ooh, somebody says it's good enough. Some brave soul out there. Okay. 1 more minute for the poll. It's just really interesting to see how everybody thinks about ESG data because it's not the same as financial data. It only comes out like once a year in a sustainability report. It's very different. And what's great is that we have these quantitative investors on this panel that are thinking about it. So yeah, everybody would like to know more about ESG data or they don't trust it. Can we go to the first slide? We have about ESG data. We've been looking at Bloomberg on how many companies are actually reporting sustainability data now. So there's definitely a critical mass now. About 86% last year published sustainability reports in the S&P 500. And just in 2011, it was 20%. So that's gone up a lot. And we have another slide showing kind of what kinds of ESG data we get. That's not the right slide. But we're going to wait for it for 1 second. We're still going to wait for it. There it is. OK, so for the Russell 1000 ESG metrics, we looked at Bloomberg. We track all this ESG data. And we found that the number of companies reporting ESG in public filings, it's only like 300 companies report greenhouse gas emissions. The percent of women employees is the fastest growing metric in ESG. But if you want to know employee turnover, there's still only a handful of companies that really produce that information. So we have all these investors here who say, you know what, that's good enough. I can make quantitative strategies out of that. And so I'd love to hear from each of you, starting with George. Tell me a little bit about what your approach to ESG from a quantitative lens is at your firm.
Yeah, so at PanAgora, we have a unified ESG framework that we've developed. And it's really based on 3 pillars. The first is alpha. We really believe there's alpha in ESG. And it's really based on the premise that most assets in U.S. companies around the globe are intangibles. So what are these? They're not plant and property equipment anymore. It's things like brand strength, employee sentiment, network externalities. So in order to capture that, you need a lot of data. And a lot of this falls into the realm of ESG. The second thing is materiality. We have dozens of ESG factors, but they're not all applicable across the whole universe, and they're not really even applicable within the same industry. If you think of these types of metrics we're talking about, environmental factors, Netflix and Disney are in the same industry, classified as media. Disney has a huge physical footprint, and you should really look at environmental issues more for them than something like Netflix. And the third one is customization. A lot of asset owners who look in this space of ESG have their own needs and desires to implement into their portfolio. So we are able to quantify how much we can add to their portfolio, combining our ESG alpha with their specific goals, whether it be diversity in the workplace or environmental goals.
Yes, and this chart on the screen we're going to address later, so just hang on. It's out there for you to think about in the meantime. So Asha, tell us about what you guys do quantitatively at Acadian.
Perfect. Thank you. I'm delighted to be here and so glad that there's a panel on ESG at today's session. I'm with Acadian Asset Management, and we are coming on our 10-year anniversary of signing the PRI. We were the first quant actually to sign on as a signatory 10 years ago. And part of the reason why we were able to do so back then was because in many ways we were already integrating ESG in our investment process. We already had the view that ESG issues are critical investment issues, and we didn't take that tack because there was some market pressure to integrate ESG, but because it made sense, as sort of George outlined. A lot of these themes are basic investment principles. And so if you can account for exogenous data, you've got the investment theory behind you, and you're able to assess efficacy in the context of a back test, then that's the type of ESG signal that we are looking for. So we were already doing this way back when. We've continued to advance our ESG agenda over the last decade or so, again, bringing these principles behind it. Is there an investment thesis behind it, and what's the efficacy to support those signals? To that end, when a signal goes into our investment strategy, the objective behind it is certainly not a do no harm type of implementation. We hold all of the signals that go into our model to high standards of efficacy. So we expect ESG to add value to our portfolios.
Tim, tell us about what you guys are doing at Arabesque.
Sure, and thank you so much for giving us the opportunity. So basically at Arabesque, we're still a very young asset manager, but the core kind of belief and the fundamental principles upon which Arabesque was founded was exactly the ESG quant belief. So thinking that you can take a quantitative approach to investing, which in general we think makes a lot of sense, and then use ESG basically to integrate that within that quantitative approach. We very much don't look at ESG as this kind of standalone set of information, or this new kind of fad which came on the market, and the only reason we're looking at it is just because it's trending or whatever, but really because it represents kind of the first maybe of a new set of data which is non-financial in nature, but fundamentally you need to integrate with other financial data to get just a better understanding, more information, more more insights into companies and their ability to perform in the long run. If you put those two together, so that extra piece of information, and you multiply that, you exploit that using quantitative techniques, because you can do that at scale, we really find that to be adding a lot of value to our investment process. And it's only getting better because we're getting more data, computers are getting faster, it's getting cheaper to store data as well. So this is really something that we see going a long way.
That's a really great point, that more information is better. And Debbie, tell us what you guys are doing at BlackRock.
Sure. I'm part of a team at BlackRock known as Systematic Active Equity, SAE. And our focus on quantitative investing has really, over the last 10 or so years, dipped deeply into the use of technology to help us understand the world around us. So we're a team that's animated by research and have been for the whole 30 plus years we've been around. But our investment in and around technology really has a couple of implications. First, we're able to look at and consume a significant amount of unstructured information. And I say that because there is an inherent information asymmetry in ESG. There's a lot of information that we as investors would like to know. And as your starting slides have highlighted, Emily, not all companies are reporting ESG information. And so all investing has asymmetry in it. We think that having the ability to go out and find information, whether it is structured or unstructured, to incorporate into portfolios is a critical skill for ESG. And then using, yes, the technology, computing skills, and advanced analytics to better interpret that information is key. The implications for ESG for us are twofold. On the one hand, there is a large market of third-party data provider information, and that's important information for a lot of investors. In the case of our team, we're an active investing team. We have a focus on proprietary research, and we continue to have a heavy focus on that. So we don't consume third-party data for ESG scores to implement in our portfolios. So to the question that you had on the screen about data, it's just not the approach we have. Instead, that second implication is we're really committed to continuing to deepen research and insights around ESG, and then certainly share those insights into the marketplace when we can. There is not a lot of research, academic or otherwise, about quantitative investing and ESG, and we think it's important to help move forward this entire market to share a lot of what we're learning.
Yeah, it's been talking a little bit about how there's this huge dilemma on ESG data, and now we're ready for that slide. Because we actually asked all the quants here to show us some signal that they're actually chasing in ESG, or something where they see the real value from a quantitative perspective. So George, why don't you start with your chart here?
Right. Well, so if you think about it, today, employees are the most important asset of a company. To be a leader, you need to show innovation, leader in intellectual property, and that all comes back to employees. Can you attract and maintain or retain the best employees, and are they happy, and would they recommend the job to their friend, and do they agree with the management of the company? So previously, if you asked a CEO, or if you even today, are your employees happy? You'll get 100% of the CEOs say yes, right? And there's no way to verify that. But today, we use our web scraping technology to kind of monitor the chatter of employees on social media, on employee sites. We take all that, and then we apply machine learning technology to capture sentiment. So our example here is, Tesla. It's on an ESG metric. They probably rank well because it's clean energy and lower pollution. However, there's another aspect to it, is how did you treat the employees? How do they like the company? And from this chatter, we've seen, even though there's a lot of headlines about Tesla and the driverless cars and self-driving car technology is leading the pack, internally the mood is getting more and more sour, and probably missing deadlines, and the financial losses they're mounting is weighing on the employees, right? And if you read some, that's what they're talking about. And this precedes stock price. So if you see sentiment of employees falling, it's going to lead to lower stock price in the future.
Wow, that's a really interesting social metric, and you can see its effect on the market. That's a really great graph. Thank you for sharing it. Asha, can we go to the next slide? My clicker's not working. There we go.
Yeah, perfect. This is terrific. I'm going to pick up on a lot of the themes that have already been touched on. And I think, Emily, you phrased the question around what are the themes that we're chasing or we're looking at, and the big one is materiality. You introduced the session talking about data. To what extent do you trust the data? There are a number of data providers out there today, Bloomberg included, that cover ESG. And the challenge as an investor, and as a quantitative investor in particular, is to be able to decompose the ratings that come to us from third-party data providers, and to assess, of those inputs, which of these are going to be important for corporate success, and which of these, therefore, will be relevant in the context of returns. So what I'm showing here on this slide, it comes from an academic paper, one of the seminal papers in the space of ESG, that highlights the importance of materiality. What the chart is showing is returns associated with different companies. The vertical axis is differentiating companies based on their adoption of ESG practices that are material. So I'd agree with the comment around employee sentiment being a material investment theme. To what extent are companies planning for a low carbon future potentially is another one of those material signals. So companies that have adopted strong ESG practices would be plotted at the top of the chart, and companies that have adopted weak ESG practices with respect to material issues are at the bottom. And then on the horizontal axis, they're plotting companies with respect to their adoption of immaterial signals. And what you can see from a returns perspective is sort of what you'd expect in the lower left. Companies that have not adopted ESG practices at all are underperforming, so they're posting negative relative returns. And in the upper right, these are companies that have adopted beneficial ESG practices, regardless of material or immaterial. They're active on these ESG dimensions, and you can see a nice spread. They're posting 2% relative, so 4% spread. But where you get the most pop, the strongest return, is in the upper left-hand corner, the one that's highlighted in dark blue. I think of this as kind of a bang for your buck type of theme, where companies that are proactive on material ESG signals do well, And they do particularly well if they're not proactive on the immaterial ones. There's sort of a resource allocation argument here. This is why I think of it as the bang for the buck. You want companies to really be focusing their resources on those dimensions that are most important. So that slide was talking about returns, and it speaks to the alpha opportunity of integrating ESG signals, how you can boost returns in your portfolios. This other slide is plotting volatility associated with companies with various ESG ratings. So on the far left, we're showing AAA ratings. These are MSCI ESG ratings, and a AAA rating, sort of like the bond ratings, suggests good practices. CCC at the other end of the spectrum is showing companies with poor ESG practices. And here you see not the alpha side, but the risk side. Companies that have poor ESG practices, so those CCC ratings, actually have higher volatility associated with them. So this is the way we sort of approach ESG at Acadian. We're looking at ESG signals that can either enhance returns or mitigate risk or other dimensions of volatility.
That's so interesting. Tim, you were also going to talk about materiality.
I am, yes. And this was actually a perfect introduction for me because I don't need to explain materiality anymore. So basically, we're looking for, okay, in all of this big data that I mentioned, you mentioned before, like more data is better. Well, more data also means more noise, but it also gives you as a quant investor the opportunity in all of that noise, in all of that kind of faux signals which aren't really telling you much. It gives you the opportunity to look for the actual signal which is telling you a story. This is also why, by the way, I believe that you can actually use this ESG data and this kind of proliferation, explosion of ESG data to actually generate outperformance, because there is hard work to be done in order to get a signal. That being said, coming back to the materiality principles, so Asha mentioned the great paper and the research that was done, for example, by the Harvard Business School. One thing we did, in addition to kind of what they've been looking at, is look at materiality also from a dynamic point of view. So rather than thinking of materiality of like, okay, for every industry there's this fixed set of indicators or metrics that drive returns, we think of it as this could change over time. In addition to that, also we think that it's something where you can't look at ESG data in isolation. Coming back to my previous point of it's one big informational space, and ESG is just a subset of that information. What I'm showing on the slide, and I won't go into too much detail, but basically I'm showing a two-step approach where in the first equation that you can see, you try and apply, let's say it's a simple factor model, to understand how financial returns are already explaining cross-sectional variation in returns. Once you've done that, you're left with a residual, which is part of the returns you were unable to attribute using, let's say, a value, a momentum, or an overall market beta factor. The question then becomes, from a materiality point of view, which factors, ESG factors, can I use to explain the residual? Not directly the returns, but the residual, because this is what's unexplained by financial factors. And that's what you see on the slide. There's some backtesting results there as well, which shows that this works really well, like this integrated approach of first accounting for financial data and then for ESG data. And also by doing this on a regular basis, not once, but every quarter you can rerun this. And hence you can update your signals, you can update your knowledge of what is material and what is not.
Debbie?
Sure. One of the things that we've learned at BlackRock in these years of growing interest in ESG investing is that a number of investors are interested in both the financial and the sustainability outcomes of their portfolios. So we are, of course, without saying, very interested in what my colleagues here on the panel have talked about, which are the return and or risk implications of thinking about ESG. But we also wanted to do research and try to understand what are some of the sustainability outcomes that we could consider. And so the slide in front of you, I'll explain what it is, why we did it, and a bit of an addendum. So what is this? You're looking at the number of ESG policies at a firm on the horizontal axis. As that number increases, when you look at that vertical axis, you'll see we're plotting percent of controversies taking place at a firm. So if you're looking at this real time, you should be surprised, because we were actually surprised when we first saw this result. You'll notice that with more ESG policies in place, firms were actually experiencing more controversies. This is counterintuitive, so let me explain why did we do this analysis in our team in SAE. By the way, we published this research in the Journal of Investment Management. I mentioned we do want to contribute research into thinking about ESG, and we thought this was a pretty important paper to publish. We were fortunate to get an award for it from the Journal of Investment Management, one of 3 distinction awards that year. So what do we think is happening? In our paper, we normalize for things like the size of the company, the domicile country, the sector, and these findings persist. We do not suggest that there is a causal relationship, that ESG policies are bad. This is the addendum, I promise. This is not. This is unfortunately been interpreted as saying we don't think ESG is good. That's not the case. But we do think this matters. The reason we got into this analysis is a number of rubrics that would like to rate companies on how effective they are with ESG use as a key input in their methodological schema the number of ESG policies at the firm. So we simply wanted to decompose. I mentioned already that we're not consuming outright external scores. We wanted to decompose what is it that people are saying important, and would we agree that there's an investable thesis? So if the thesis is more ESG policies is better, this analysis would simply give us reasons to pause, think about that carefully, and decide how would we want to position the portfolio, because you can see the unintentional implication of positioning into more ESG policies could actually be positioning into more controversies at the same time, which for the ESG objective of many investors is not the goal. We also know that there could be damaging financial implications of positioning that way. So this has been a very interesting insight for us. We have certainly a body of research that has emanated from it.
Wow, these are really fascinating. I'm so glad that we got you all to explain that. I wanted to quickly ask a couple factors questions. Asha, when you look at the environmental factors, you were saying you were looking at carbon pricing and seeing that in the market. How do you see, relatively quickly, that factor playing a role in the market?
Fascinating discussion, and I think it picks up a lot of themes. Again, I was, like a lot of comments on the panel already, sort of surprised that we were tackling quant and ESG at the same time. One of the few sessions that is really focused on quant technologies is tackling ESG, and we sort of live in a world where big data is coming to the forefront, machine learning, natural language processing. We have more and more tools, and at the same time, intangibles and other dimensions of ESG and sustainability are coming to the forefront as well. And I think that in many ways, quant managers are sort of well positioned to tackle these issues related to data. And the carbon pricing issue, I think, is a classic example where carbon pricing is more and more an important investment theme. Essentially, all global leaders have come to the agreement to sign the Paris Agreement. It is, of course, non-binding. But we recognize that there is momentum toward a low-carbon future. So how do we price this into portfolios? It's considerably challenging given the issues out there. One is lack of data. We cover 40,000 securities across the globe, and only 2,500 companies actually report their carbon emissions. So one of our challenges is to identify values for all of that missing data. And we can use some of the tools that we have along the lines of imputation, web scraping, and other tools that we have to fill in those missing values. The other challenge, it's not just what is the underlying data, but then how do we associate a potential carbon price with the value of a company. And here we can use quant tools to assess either those linear relationships or nonlinear relationships between carbon pricing and corporate valuations. So using the technologies we have, we're able to adjust the valuations associated with companies that have more exposure to that carbon risk in a way that's dynamic and accounts for the fact that, of course, there is no such thing as a global carbon price. But these are some of the issues that we're tackling.
And George, really quickly, could you talk about greenwashing and how you guys are using natural language processing around that?
Yeah, so one risk in using a lot of this ESG data is that the companies know that shareholders and other stakeholders want them to say that they have LEED buildings and diversity in the workplace. So they hire armies of people to pump out press releases to say that they're very green. Now the thing is, as researchers, we have to cut through that. So actually what we've done is we collect all the corpus of documents that a company presents, and we actually find that companies that actually speak a little more negatively about themselves on ESG metrics might have bad scores today, but they actually will improve in the future. And improving ESG metrics tend to lead stock prices. So that's one way we can get around that.
Okay, and to wrap up our panel, we have one lightning round question: is where does each panelist think ESG data is the strongest? We'll start with you, Debbie.
Sure. I think around management quality.
Well, probably alignment of long-term performance with short-term kind of compensation. So compensation alignment with long-term outcomes.
I'd agree with sort of the broader theme around governance across E, S, and G. Clearly, the academic and the buy side, the sell side research, and therefore the disclosures related to governance are the strongest.
I think sentiment is the all-star ESG factor. It's hard to manipulate, and it's the best way to achieve risk-adjusted returns.
Well, thank you for a wonderful panel, and thanks to the Invest audience.